Howdy everybody, Professor Martin here, and we are beginning our accounting journey today in Solid Footing Chapter 1. Now, a lot of classes, Chapter 1 is that intro chapter, like, what is psychology? And you don't really learn anything in Chapter 1. Not going to be the case here. We are getting hard and heavy into the accounting right off the bat. And really important in the first couple of weeks of accounting to absorb what's going on, because what we're doing at the beginning here is we're laying out the foundation for accounting. Okay, if you've ever seen a house being built or know anything about building, you can't really put a roof on a house, you can't put walls up on a house until you build that good solid foundation. It's the exact same in accounting. What we're doing right here in the early going is going to be the foundation for everything we're going to do down the road. So I'm not trying to scare you. I'm just telling you, if you can kind of tune your brain in and out, you really want to tune it in weeks 1 through maybe 5 or 6 here as we go along and build that accounting foundation. So enough of that. Let's get to the accounting. Solid Footing Chapter 1. What do we got going on here? Our accounting journey is going to begin with an equation. Now, don't freak out when I say that. I don't want people that aren't really big math people to hear the word equation and be like, oh my gosh, I'm not going to be able to do accounting. We have equations involved. All you really need to know about equations here is that they need to be balanced on both sides at all time. And we're going to kind of play off this idea of an accounting equation all through Chapter 1, really all through the entire accounting class. But all you really need to be familiar with is the idea that one side of our equation has to equal the other side. So our very introductory equation here is an idea of stuff equals claims to stuff. Now, stuff is what we own, or what a business owns. And you can look around the room right now. Maybe you have a laptop, maybe you have a TV going, maybe you have a vehicle sitting out in the driveway. All that is stuff that you own. And you think about a business. You think about Walmart. Walmart has inventory sitting on the shelf. They've got vehicles. They've got buildings. They've got registers. They've got all kinds of stuff. So stuff is what a business, or you, if you want to use yourself as an example, own. On the other side of that equation, who has a claim to that stuff? And who has a claim usually falls into two different groups. Usually the owners have a claim to the stuff. So you think about the stuff that you have sitting around, you're an owner of that stuff. And also creditors have a claim to stuff. You think about maybe your mortgage on your house. You maybe don't own your house outright. You had to borrow some money to get it. So everything that you or a business owns is equal to who has a claim to it. The money you put in, or the businesses put in, and maybe the money they got from creditors to get the stuff. So that's where we need to begin, right there with that equation. And that's going to be the foundation for our entire accounting system. So just to kind of put some numbers to it here, to give you an example, I've got a Toyota Tacoma, my beloved Black Beauty pickup truck, sitting out in the driveway there. And let's just say, for the sake of argument, that truck set me back $30,000. Now, I'm on the Southern State Payment Plan here. I'm just a meager accounting professor at a community college. I don't have baller money where I can walk into the Toyota dealer with a suitcase of $100 bills and be like, hey, I want to buy that truck. I had to go a different route. I had to say, I've got $5,000 that I can put towards that truck right now. I had to go to the bank and say, hey, bank, I want to buy a truck. $30,000. I've only got $5,000. Can you loan me some money? And they said, sure, you've got a little bit of credit. We'll spot you $25,000. So I was able to take my money and the bank's money and go buy that truck. So the stuff that I have, a pickup truck, equal to the claims to it, my $5,000 down payment and the bank's money. And of course, as I pay that truck off, the bank's claim will go down. My claim will go up. Okay? So that's kind of the idea behind that equation. And there doesn't always have to be a creditor involved. I'll give you another example here. If you look at your personal stuff you have sitting around. Maybe you've got some DVDs laying around. I've got a Jaws Blu-ray here that I bought recently for the home theater down in the basement. I'm not going to spoil the movie for anybody. I know we got a lot of younger people in there, but it's basically about a shark that eats everybody. You can see on the back of it, the lady there, she's about to get it. She doesn't really know it right now, but that's the way Jaws works. He kind of sneaks up on you, and then it's over for you. So I've got that video, and I went to Best Buy, picked that up. It was like $15. It wasn't anything that I really needed to go and take out a loan from the bank. I can afford to drop $15 on something like that. So I have a $15 Jaws Blu-ray in the beautiful packaging here. I think they call it like a steelbook. It's got images on the inside, hard case, whatever. So I got that, $15, and I have the entire claim to that all by myself. I didn't go to the bank. I didn't borrow any money from anybody. So 15 plus 0, no creditor money involved in that. So the idea, stuff that you have, or if you want to use business and think of a business, the stuff a business has is always equal to who has a claim to it. The owners that put into it, and also any creditors that kicked in money to help the business or the person buy the stuff. If you can handle that idea, then you're ready to build the remainder of the accounting foundation over the next couple of weeks. So here we go. Let's add to that key point. And just to kind of show you the way these notes are set up here in accounting, I'll put blanks into the notes. You can print off these PowerPoints and follow along and fill in the blanks with me. If you don't have a printer at home, you can get some notebook paper, fill it in that way, and take the notes that way. So I try to make it a little bit interactive instead of just me sitting here talking. But our key points so far, and we're going to update this accounting equation later on, but right now, we're just going to say the stuff that we have is equal to who has a claim to the stuff. Right on? So let's add to that. In Chapter 1 in Solid Footing, we're given a simple example that we're going to build an accounting system around. The idea is that you and a sibling are going to partner up, and you're going to keep a bucket of money by the door. Now, why would anybody want to keep a bucket of money by the door? The example says that the idea is they're going to keep that bucket of money by the door so they can kind of put money in it and have running around money. They go out on Friday night, they can just grab some money out of the bucket and off they go for a good time. So our business we're kind of working with here isn't really a business. It's just a bucket of money by the door that two people are putting money into, and they're going to kind of share that money. So the concept of the money bucket we're going to adapt into a business later on, because everything we're doing with the money bucket can be adapted to a business from an accounting standpoint. So what we need for our money bucket here, we need an accounting system. And all an accounting system is a way of keeping track of what we have and also who has a claim to it. Whether we're talking about a small business like Big Ernie's Pizza there in Hillsboro, or we're talking about a huge company like Apple, the idea is the exact same. Keeping track of what we have and who has a claim to it. So, hope you're sitting down. We're going to introduce our first accounting system here. And it's a very simple accounting system. It's just a money bucket. So, on one side, we have stuff in our accounting equation here. On the other side, we have the claims to stuff, just like we saw in our accounting equation. But now we've added a couple of little half T's here. And those half T's are going to represent accounts. We'll have a separate account for everything we want to keep track of in our accounting system. So go ahead and draw out these T's here, use your note templates that we got. And we're going to have one account on the stuff side, our cash bucket. That'll keep track of all the money that goes in and out of that bucket. On the other side, who has a claim to that cash bucket? Well, right now, only the two owners. We have my claim as I put money into the cash bucket. And these are ownership claims right here. And we'll say our sibling has a claim as well because she's going to put money in the bucket too. Alrighty, so we have on one side of our equation, our stuff, on the other side, the claims to it. Now we get to do transactions. We're going to do some accounting here. Exciting stuff. I got transaction number 1. I'm going to come along, I'm going to throw 200 into that money bucket. So I'm simply going to kind of put a number here for that transaction. And here comes 200 into that bucket. So if you can visualize a bucket of money sitting by the door with a couple $100 bills in it, that's what we got. Now, I told you all we needed to really know about the equation is it has to be on balance on both sides at all times. I got 200 on one side. I need to put 200 on the other. That other 200 is going to go under my claim. I put the money in. I have a claim to it. There we go. Transaction number 1 has been put into our accounting system. Notice the equation, 200 on that side, 200 on that side, still in balance. We have achieved accounting harmony. Number 2, sister comes along. She says, I'm going to put 150 into the bucket. So she walks in, drops 150 into the bucket. Now she has a claim to 150 bucks in that bucket. So at that point in time, in my accounting system, I can look and see, hey, my bucket has $350 in it, total. The claim to that bucket, my claim is 200. Sister has a $150 claim. And you put those together, we have a $350 claim to the money in the bucket. 350 on left hand side, 350 on the right hand side. And of course, real accounting is a little bit more involved than that, and we'll kind of uncover that as we go along. But basically, an accounting system is going to log in transactions and keep that accounting equation in balance. That's all that's happening. So we move forward. Now we can make an accounting report. An accounting report summarizes what's in the accounting system. And there are all kinds of different accounting reports that we're going to learn about. Right now, we're just going to give it a generic title, a report of stuff and who has a claim to the stuff. Ooh, that was supposed to be circling that word. Did not work out at all. We'll fix that in the edit maybe. But right now, our cash bucket has $350 in it. So our total amount of stuff, $350. My claim in that bucket, $200. My sister's claim is $150. So together, we have a total claim of $350. The stuff that we have, our money bucket, is equal to the claims. So this is just basically giving some numbers to that equation and showing you how it works here. So with that being said, let's move forward one more step and add a creditor to the fold. We got the money bucket. We're using that money bucket. Dad comes along and says, hey, why is there a bucket of money by the door? Well, obviously, Dad, it's there because we're using it to fund our going out on Friday night. So Dad says, hey, that's a great idea. I'd love to have a bucket of money by the door. Why don't I loan you some money to put into the bucket? So at this point, Dad's going to contribute to the bucket, but he's not an owner because he wants to be paid back. We're not cutting him in any kind of ownership. He's just going to lend us some money. So we're cutting Dad in here. We're adding to that example, and we're going to set it up in our accounting system where we can now add Dad in. So we're going to walk through the exact same transactions we've just done, but we're also going to include Dad. So on the stuff side, we have our cash bucket. Set him up just like that. Again, we have my claim as an owner to the bucket. We have the sister giving money to the bucket. And now we have Dad. But Dad's a little bit different because Dad's a creditor. He's not an owner. But he still has a claim because he's loaning that bucket some money here in a second. So number 1 and 2 are going to work just like they did. I'm going to pause and kind of throw those in. And you can do the same and check against my work. Just in the interest of saving some time here, I'll do number 1 and 2 just like we did in the previous example. All right, so just like we saw in our example from before, we've got our cash bucket with $350 in it. That came from $200 that I have put in and $150 that my sibling has put in. So we've got number 1 and 2 taken just like we had done before. And now we're going to add to it a little bit. Number 3, our third transaction, our sister comes along and she takes $20 out of the money bucket. I mean, she's out and have a good time. She needs 20 bucks. I'm not sure how far 20 bucks is going to get you and having a good time these days, but that's what she does. So transaction number 3, we got some money coming out of the bucket. Ooh, $20. I'm going to put a little negative right there. 20 bucks coming out of that bucket. And again, in our equation here, both sides have to balance all the time. I just took 20 bucks out of one side. So I'm going to have to come over here and I'm going to take $20 out of her claim. Because she took money out of the bucket. She took money out of the business. She doesn't have a claim to that money anymore. 20 bucks out the door. I've got $330 on the stuff side. I've got $330 on the claim side. I'm still in balance here. Number 4, I get a little jealous. Sister went out and had a good time, so I want to go out and have a good time too. Typically, men don't spend the money that women do, and this is a good example of that, right? I only take 15 out of the bucket. Of course, I'm joking there, but I'm going to take 15 bucks out of the bucket. I've offended everybody 15 minutes into the first class here. 15 bucks came out of the bucket. So my claim goes down 15 bucks. A little negative 15 there. So now my claim's only 185. My sister's claim is 130. The total claim, 315. Total stuff, 315. So now Dad comes along. He says, hey, I'm going to loan you $100 and you can put that in your money bucket. Oh, great, because people are taking money out when you put some money back in here. So transaction number 5, Dad comes along and he gives $100 to the money bucket. Boom, $100 goes in. Now Dad has a claim. $100 going up on that side. Okay, that's number 5. And then of course, we have a loan. We got to pay it back. Otherwise, Dad's going to send somebody to bust our kneecaps. We don't want that to happen. We don't want somebody showing up with a crowbar demanding their money back. So on number 6, we're going to pay Dad back 25 bucks. We're going to pay him back in installments here. So $25 comes out of the bucket to pay Dad back. Well, where does that come out of? Does that come out of my claim? Sister's claim? No, it doesn't have anything to do with their claims. It has to do with Dad's claim. So his claim goes down 25 bucks because we no longer owe him that 25 bucks. So now we've come to the end of these transactions. We can kind of total up what's in the accounts. We can total up that cash account. We can total up the claim accounts here. See what's in them at the end. Again, that accounting system's keeping track of what we have and who has a claim to it. So our cash bucket, 350, 330, 315, 415, 415 minus 25 gives me 390 bucks. I have 390 in that cash bucket. I don't even have to go and count it. I got some weird stuff going on there. My pen is lagging. Computer can't take all the accounting information I'm throwing at it. I got 390 on stuff side because that's what's in my cash bucket. My claim to that 390 is 185. My sister's claim is 130. And my dad's claim, 75. You add all that together and it should equal 390. So what I'm hoping you're getting at here, what you're seeing, that accounting equation is remaining in balance after every single transaction we do. And we did a lot of them there. 6 transactions going on there. Every time a transaction happens, that equation is staying in balance. So now we can take that little accounting report I showed you earlier and put a little bit different name to it. Instead of a report of stuff and who has a claim to it, I'm going to call it a balance sheet. So here it is. First accounting report that we're learning, the balance sheet. Balance sheet is simply an accounting report that shows you what we own and who has a claim at a specific point in time. And because it has that word balance in it, tells you balancing is pretty important. The balance sheet always has to be in balance. Always. I'm not marking that out. I meant to underline it. Everything's kind of going uphill today on the computer. But anyway, our cash bucket at the end there, we had 390 in it. So I have $390 worth of stuff. Dad's claim as a creditor, 75. My claim, I believe, was 285, wasn't it? Or 185, yeah, that's right. My claim, 185. my sister had a claim as well, and I think she was down to 130, according to my totals there. So we add those up, 75, 185, and 130, and I get 390. So the idea behind the balance sheet is it's an accounting report that's going to show you that the stuff that you have, that total stuff, is equal to who has a claim to it. That's why they call it the balance sheet, because the two parts have to balance. It's showing you that accounting equation. Stuff equals claims to stuff. So let's get real for a second. We've kind of had the training wheels on, and I've been putting stuff in layman's terms for you. In the real world, accountants don't really look at it as stuff and claims to stuff. We have accounting terminology that goes along with it. But I didn't want to throw the accounting terminology at you right off the bat. I wanted to put it in terms that we could relate to. So now let's take the simple terms and put it into accounting terms. We've got stuff. Yeah, stuff that we own. The stuff that we own in a business is called assets. So when Walmart buys a building for a store, they bought an asset. Something that they can own, that they can use to kind of operate the business. What about those claims to stuff by people who aren't an owner? Well, those are creditors, and those claims are called liabilities. If you have a loan with the bank, you have a liability to the bank. You are liable for paying that back. So we have assets, we have liabilities, and then finally, those claims to stuff by the owners of the organization, the people that put money into the cash bucket, the people that put money into the business as an owner, that's called owner's equity. So that's the accounting terminology right there we need to be familiar with. Assets, liabilities, and owner's equity. And what we're going to do is we're going to take those terms that I just put right there, and we're going to plug them into that accounting equation. So instead of stuff equals claims to stuff, now we have assets, what we own as a business, equals the liabilities plus owner's equity, who has a claim to it. So what we own and who has a claim to it. Okay? Now, here's the beautiful thing about accounting. I always hated classes when I was taking classes, throughout my life, where it was one of these things like, we're going to kind of show you something now, and then later on we'll show you that what we showed you is completely wrong, and this is the way it really works in the real world, or whatever. Well, accounting, whether we're sitting here at an Accounting 1101 at Southern State, or whether we're talking about the Masters of Accounting program at Ohio State University, this accounting equation right there is the same. This is it, y'all. This is how accounting happens. That accounting equation right there. Assets equal liability plus owner's equity. You need to tattoo that into your brain. That is the center of the universe in accounting. If we're thinking about Moses coming down off the mountain with 10 accounting commandments, this is accounting commandment number 1. Okay? So, and again, it holds true whether we're talking about accounting right now in Accounting 1101 or Accounting 6500 at Ohio State University. It's the same idea. It doesn't get modified. Assets equal liability plus owner's equity. So make sure that you understand that and remember it. Write it down if you want to, right there. So we'll update our little money bucket accounting system. Okay? I've got assets equal liabilities plus owner's equity. And I'll kind of fill this out again and label these little accounts here. I'm going to pause it so you don't have to sit here and watch me do it. And you can kind of update your notes as we kind of do that. But we got our cash account right here, just like we did before. But now under liabilities, instead of calling that dad's claim, I'm going to call that note payable. Note payable means a note, we have some kind of document that shows we owe money and how much we owe. Payable just means we have to pay it back. So when you go to the bank and borrow money, you're borrowing on a note, basically. So we got a note payable to dad. So I'm going to say note payable to dad. We owe dad some money. That's a liability. He's a creditor. Then on the owner's equity side, instead of my claim and sister claim, I'm going to call it my equity. I'm replacing claim with the word equity. Equity means ownership. Kind of redundant, right? Owner's ownership, but that's what it's called. I love redundant. Oh, accounting is so redundant. You'll find that out. I'm a routine guy. I like routine. I like redundant. So here's my new accounting system. Cash under the asset side, something we own, is equal to who has a claim. Creditors in the form of a liability, a note payable, got to pay back dad, and owner's equity, my equity and my sister's equity. We are the two owners of the bucket. All right? All the transactions here are the exact same. So I'm going to pause here and let you try to fill these out, and I'm going to fill them in. We'll check against each other after I unpause here. All right, so we're back. The accounting didn't change. How we put the transactions in, it didn't change at all. All we did was put accounting terminology to the accounts. And now I have assets, liabilities, owner's equity, and I've got more accurate descriptions on the accounts. I've got my cash bucket still, but then I've got note payable instead of dad's claim, because I've used a more descriptive term to describe what kind of claim it was. A note payable. I owe my dad money on a note. My equity, my claim, my sister's claim. All the transactions are the same. We put them in the exact same way. We just used accounting terminology and kind of transformed our accounting system in doing so. How we recorded the transactions didn't change at all, but it will. Here we go. How is it going to change? Before we get into that, let's look at our new balance sheet. We'll also put some new terminology onto that. Here's our old balance sheet right there that we did before. And notice the numbers didn't change at all. All I did was substitute the new terminology here. Assets instead of stuff. Liabilities. And owner's equity. So we're just updating what we already know with the new terminology here. Here's my balance sheet. Assets are equal to liabilities and equity. It's a balance sheet. It has to balance. Assets equal liabilities, equity. So here's the beautiful thing. Like I said before, we are now about 25 minutes into your accounting education, and we've learned about the balance sheet and what it is. I'm showing you right now the balance sheet for Apple Incorporated, one of the biggest companies in the world, one of the biggest companies in America. And I want you to look. This is straight from their financial reports. Balance sheet. You know what that is. It's an account that shows you assets equal liabilities plus equity. Right? We just defined that, just showed you that. So here's my total assets. Everything that Apple owns. And down here, you can't really see it because I can't show the whole thing. But if I could show you the whole thing, you'd see down here liabilities and equity would equal that number. So what a business owns and who has a claim to it. And look, right up here. Here's Apple's cash bucket. You say, wait a second, Apple only has $48,844. Where's all that money I'm paying for my iPhone going to? Oh, hold on a second. This is in millions. So that's 48,000 million, which if you put all the zeros behind that, you're talking 48 billion with a B. Apple's cash bucket has $48 billion in it. So how much money does your cash bucket have in it? I don't know about y'all, but mine doesn't have nearly 48 billion. You got to be shifting that decimal point over really far to get into my cash bucket here. But the point is, we're 20 minutes into accounting education. We can already pick up a financial statement from a company and look at it and start to understand what it's telling us. And that's so important. So we forge ahead here. With that being said, we need to make one more little adjustment to our accounting system. Just one more, I promise. We were making accounts that were like a half T. There's or an upside down L, or whatever you want to call that shape right there. And every time we put in a transaction, we kind of specify if it was a plus or a minus. You know, we'd take money in, we put money out, whatever the case might be. In the real world, we don't use a plus and a minus into the accounts to keep track of them. We don't do that. We add a second side of the account. And whatever side we're on determines whether it's a plus or a minus. Okay, so we're not using plus or minuses in real world accounting when we put stuff into the accounts. We're actually determining plus or minus by what side of an account the number goes into. We have a left hand side of the account and we have a right hand side of the account. And I'm going to make it real simple for you. Okay, because this is kind of where a lot of people get confused in accounting. So we're going to make it as simple as we possibly can here because we like simple in accounting. The two sides of an account are called debit and credit. Okay? Now, I want you to forget about everything you know about debit and credit. And you think about, well, I got a debit card in my wallet, or I've got a credit card in my wallet. I understand. No. Everything you know about debit and credit, I want you to forget about it. Everything. Because I only want you to know one thing about debit and credit for accounting purposes. I'm going to do some accounting brainwashing here. Everything you know about debit and credit, forget it. Because I want to imprint upon your brain what you need to know about debit and credit. Here's what you need to know about debit and credit. I want you to raise your left hand for me. Okay? I'm serious. I can't see you. Put your left hand in the air. If you're hanging out at home and you're watching this video and people are looking at you like, what are you doing? And they're going to think you lost your mind. But I need you to put your left hand in the air. And I need you to say with me, debit. Left hand in the air. Say the word debit. Debit means left. That's all it means. It doesn't mean up. It doesn't mean down. It doesn't mean debit card. It means left-hand side. Debit is on the left-hand side of an account. Raise your right hand in the air and say with me, credit. Right hand in the air, credit. Credit is on the right-hand side of the account. That's all debit and credit mean in accounting, y'all. That's it. Debit on the left. Credit on the right. All it's doing is talking about the two sides of an account. So here's my T that I just showed you when I was getting out a second part to our little account here. So I kind of draw a line here. Man, my lines are, I don't even know how to fix that. Ugh. Yeah, let's just erase that. I can't go out like that. Need my eraser here. I got to get rid of all that. That's just terrible. I got to have some quality control here, right? So switch back to my pen. Let's see if we make it a little straighter. There we go. That's close enough. So there's my account. All debit and credit is left and right. Debit on the left, credit on the right. Okay? Now, where we put the number determines whether it's going up or down in that account. All right? Debit on the left, credit on the right. If you want to help remember that, you can get a tattoo. You see some people with the knuckle tattoos that are really hardcore. You can get debit on the left hand, D-E-B-T maybe, and C-R-T on the right. Help you remember that. And if you ever go to prison, nobody's going to mess with anybody with the debit and credit tattoos for accounting because they won't know what they are. They'll be freaked out. So, how do debits and credits make accounts go up and down? If there's anything that you're going to get lost on, it's right here. This is the number one thing that people come back to. I don't understand why one side goes up, why one side goes down. So really think about this and study it and practice it and commit it to memory because this is really the key to your accounting right here. We know debit is left. We know credit is right. How do we know if it's making a number in an account go up or down? How do we know if it's adding to that cash bucket? How do we know if it's taking away from the cash bucket? We have two sides to the accounting equation. We have a left-hand side. We have a right-hand side. Every account, think about that little T account I just showed you, has a left-hand side, which is the debit side, and it has a right-hand side, which is the credit side. If the account is on the left-hand side, if it's over here, if it's on the left-hand side of the accounting equation, meaning it's an asset account, it goes up on the left-hand side, or the debit side, okay? So I'm going to say that again. Think about that cash bucket we just had. It lives over here under the asset side. So that means if we want the cash bucket to go up in amount, it has to be put in on the left-hand side or the debit side of the account. If the account lives on the other side, on the right-hand side. If it's a liability or owner's equity account, it goes up on the right-hand side or the credit side. So that's the trick. You have to understand where the account lives on what side of the equation. That helps you understand how to make it go up or down. And the crazy thing is, the guy that invented accounting invented this back in like the 1400s. And we're talking about around the same time that Columbus discovered America is when the idea of double entry, double-sided accounting was born. So just wrap your brain around that for a second and think. This is something that's 15, 16, 17, 18, 19. You were talking 600 years old. Accounting systems. And imagine coming up with an idea and people are still doing that idea 600 years later. I can only think of two things. Accounting and maybe Jaws. People 600 years from now will be looking for copies of Jaws so they can watch the shark eat people. Oh, spoiler alert, I did it again. He doesn't eat everybody, just most people. So put all that together. Assets equal liabilities plus owner's equity. Now we're going to put the T accounts. We're going to make the accounts more like they are in real life. So here we go. I'm going to label my accounts here in a little bit different way, and I'd like you to kind of do the same. Here's my cash account on the asset side, something that we own that we can use to operate the business. And I'm going to put a DR for debit on the left-hand side. I'm going to put a CR for credit on the right-hand side. And think about the abbreviations there. Credit kind of makes sense. CR for credit. How do you get DR for debit? That abbreviation actually came from the Latin word for debit, which is debitar. Not to go full-on accounting nerd on you here, but to abbreviate debitar, they got DR. So DR and CR are going to be our abbreviations. And what I'm going to do, cash is on the left-hand side. So it goes up on the left-hand side. I'm going to put a little plus by debit. I'm going to put a little minus by credit. If it goes up on the left, it must go down on the opposite side. My liabilities, I have a note payable to dad. So I'm going to put note payable. And again, label these the exact same way. Note payable, debit on the left, credit on the right. Debit's always left, credit's right. That's all debit and credit is. Debit left, credit right. Now, note payable lives on the right-hand side of the accounting equation, so it goes up on the right-hand side, and it goes down on the other side, on the debit side. We got two owner equity accounts. We have my equity, and we have our sister's equity. Sister equity sounds like a nun, ownership nun. So we got debit, and we got credit. Debit and credit. Debit on the left, credit on the right. Those accounts live on the right-hand side of the accounting equation, so they go up on the right-hand side. And they go down on the opposite side. So we're going to do the exact same 6 transactions, only now we're going to put them in an actual account with the debits and the credits. All right? So here we go. Number 1, I put $200 into the money bucket. So now we have to make a decision. Does that go on the debit side or does it go on the credit side? Well, I need to make the cash bucket go up. I'm putting into it. I'm adding to it. So to add to it, it needs to go up. So that's a $200 debit to the cash account. And again, forget what you know about banking. Forget about debit cards and credit cards and I'm going to the ATM and they're going to debit my account. Forget about all that. Debit is left and credit is right. I put $200 on that cash bucket. It's going up with the debit. Now my equity is going to go up. $200. So if the accounting equation was accounting commandment number 1, assets equal liabilities plus equity, here's accounting commandment number 2. Anytime you do a transaction, debits and credits have to equal in dollar amount. I'll say that again. Every time you do a transaction, the dollar amount of the debits have to equal the dollar amount of the credits. Otherwise, your accounting system won't be in balance. You will not have achieved accounting harmony, and your whole life will be thrown off from an accounting standpoint. Okay? We are always seeking balance and harmony in accounting. And to do that, every debit has to have a corresponding credit equal dollar amount. Okay? So there's my debit. Assets are going up. Cash is going up $200. And there's my credit. My claim has gone up $200. Debit equal credit. $200 on this side, $200 on that side. Everything's balanced out there. My sibling comes along, puts in $150. Cash bucket, taking another $150 in it. Bam. So we debit $150. Now think about where that credit's going to go. I got a debit for $150. I'm going to have a credit to sister equity for $150. Debits equal credits. The accounting system remains in balance. Sibling comes along and takes $20 out of the money bucket. Whoa, cash is going down. How do we make cash go down? Well, look, you got a negative right there. Cash goes down. I got a credit. Where's my debit going to go? Here we go, right there. I'm going to debit sister equity and make it go down $20 as well. So I've taken away from this side. I've taken away from that side. Right on. Number 4, I come along. I take $15 out of that bucket. Need to subtract from the bucket with a credit to the bucket. And my equity goes down as well. That's my debit. I'm going to debit my equity. Again, debits and credits for every transaction have to equal in dollar amount. They have to. There's no two ways around it. On the 5th transaction, Dad loans $100. We put it into the bucket. So more money coming into the bucket. And now we have a note payable. We owe Dad some money. I'll make that note payable go up on the credit side. Debit, cash 100. Credit, note payable 100. And then finally we take a little bit of money out to pay Dad back. We pay back 25. I have to take that out of the cash bucket so it comes out with the credit. And there's my debit. And that's the transactions right there. So now, after you put in all your transactions for the month or however long we're doing the accounting for, it's time to total everything up. And the way we total up these T accounts is really simple. I'm just going to kind of draw a line through right there. And what I'm going to do is I'm going to start by adding up the positive side of the account. We call the positive side also the normal side, the normal balance side. So the normal side or the normal balance side, the side it goes up on. I'm going to add those up. 2, 350, 450. And then I'm going to subtract out the other side. So 450, I'm going to subtract out 20. I'm going to subtract out 15. I'm going to subtract out 25. I get an ending balance when I do that. And just kind of write end right here of 390. That's my final balance. And you say, does it matter what side I put that on? Heck yeah, it matters. You better believe it matters, because if I put it on the other side, that's saying I have negative $390 in my cash bucket. Well, that's not the case. So it definitely matters what side you put it on. You put it on the side where the balance remains. In this case, I added up the positive, subtracted out the negative, and ended with 390. Let's do that for note payable. I have 100. I have 25 taken out. That means I have 75 remaining. My ending balance right there. My equity started with 200. Took out 15. I end with 185. Over to sister equity. 150 minus 20. We end with 130. So that's the idea. That's how debit credits work. That's how we put money into the accounts to reflect the transactions. If we look, we have a total of 390 on the asset side. If the accounting gods are smiling upon us, we should be able to say we have 390 on the right-hand side. We add up the balances, 75, 185, 130. Add those together, we get 390. Accounting harmony has been achieved again. So here's what it looks like in the solid footing spreadsheet that they give you. All that stuff put together. We've already worked through it. We have the accounts labeled the same way, all that good stuff. What happens is, at the end of the accounting period, we make a little accounting report just to make sure that the accounting system is in balance. Like I said, it's very important that that accounting system is in balance at all times. So before we do anything else at the end of the month, after we've done all the transactions, we make sure we're in balance. And the report that we do that with is called the trial balance. Literally trying to see if we balance. Trial balance is a listing of every single account in the accounting system. And what we do is we just put the balance in. So cash account, we have a debit balance of $390. Note payable, we have a credit balance of $75. My equity, we have a credit balance of $185. Ooh, apologies for the handwriting again. Lagging, computer going a little bit slow. And $130 for the sister's equity. So the whole idea here is we're taking every account in the accounting system, putting in the ending balance that we calculated to make sure that debits equal credits. Once we do that, we can make all the other financial reports that we want to make. So that report is something that's never really seen by the public. Really, that trial balance is just going to be used by the accountants. So they make sure everything balances before they make the other reports, like that balance sheet that I showed you. So that's really what we have going on in Chapter 1. We take that trial balance, we use it to make the balance sheet. We take those ending balances, plug them into the balance sheet right there. So, wow, a flurry of accounting activity here for Chapter 1. I appreciate you hanging in there and sticking with me. If I were to summarize all the important things that we need in Chapter 1, and again, this isn't just an intro chapter that we can blow off and then we get to the real stuff in Chapter 2. This is the foundation for all the accounting we're going to do. So a summary of really important, must remember, don't ever forget, lest you will have a terrible time in accounting. A summary of those things in Chapter 1. First of all, the accounting equation. And we introduced a really simplified version, and then we kind of added to it and put the accounting terminology to it. So that accounting equation, write it down with me, say it with me, whatever you want to do, however it helps you to remember it. Assets equal liabilities plus owner's equity. Right on. What we own is equal to who has a claim to it, creditors or the owners. The other big thing, once we got that nailed down, we said we need to brainwash you about debits and credits, because you might think you know what debit cards and credit cards and have some connotation. We're going to want you to forget all that. All we really want you to know in accounting is that debit just means left. Debit on the left, credit on the right. And then finally, the dollar amount of debit and credit in every transaction. Every time we make a transaction, the debits and credits in dollar amount have to be equal. All right? Don't ever try to throw me a transaction where your dollar amounts in debit and credit aren't equal, because you're never going to be right. That's Chapter 1. We have a homework assignment that goes along with that. I'll kind of give you a little bit of introduction to that in a video that I'll put with the homework link. But that's where we're at in Solid Footing Chapter 1. If you have any questions, if you're struggling, let's talk about it up front. Because like I said, everything builds upon itself in accounting here in the early going. And if we're struggling at the beginning, it's hard to get that rectified later on. Hard to get caught up with it later on. So I definitely want you, if you're having problems here at the beginning, reach out and let's talk about it. Okay? Because we really need to get all that nailed down before we move forward. I'm going to stop the video. We're going to take a break, do our Chapter 1 homework, and we'll come back and we'll look at Chapter 2 in Solid Footing and build another layer onto that really good accounting foundation that we're developing. And we'll see you back here for that.